John, why the change? Let's start there.
Well, I mean, more than anything else, this is an earnings story that our earnings estimate, which when we put it out at $185 of earnings for the S&P, was the highest on Wall Street. And it's just too low. The numbers are coming in just too strong. And it's not in one group. Banks are beating by 35%. Tech is beating by almost 30%. Industrials, discretionary companies are up 50, 60% on average. And, ultimately, we needed to, increase the earnings outlook. That was what drove it. And then as we see that the overall stock market price was right on our tails, and so we moved our numbers up.
John, I got to congratulate you folks. You're looking at the guy who came out in January and said, if you sell tech and go to everything else, you're going to be out of your minds. In hindsight, John, you look like a genius. What do I do with tech? As Lisa mentioned, they didn't move on earnings. No surprise there. Are they part of your lift to 5,000?
Yes and no, Tom. I mean, we actually think that boring old economies. Listen, I've been a growth guy, a tech guy for a very long time, and every kind of stock has its moment in the sun. I don't know if this is the moment in the sun for tech. I think this is the time for old economy stocks because these are companies with big fixed overhead, that tend to respond more to the kind of stimulus that we're seeing proposed by the Biden administration and generally the kind of overheating we're seeing in the general economy.
Can we see earnings like this continue and the 46,000 maybe next year for the S&P without a commensurate rise in yields, without a commensurate read-through to the bond market? And how much is there a feedback loop here?
Well, first of all, my expectation is that we're going to see interest rates rise a little bit from here. And if you actually look at how stocks respond, they want higher interest rates. And that's because what we're seeing right now with the 10-year bond yield at 1.6 and with Fed funds at 0, it's a sign that the economy is not yet on stable footing. And so the market wants to see the demand for capital strong as a sign that things are healthier. So if we had interest rates, closer to 2% by the end of the year, the stock market is higher, not lower.